everybody knows the consumer is under pressure. That has caused the consumer discretionary and staple stocks to become a very small portion of the market. And it might look like that's an opportunity to bottom fish.
We're going to show you some numbers that suggest that maybe they're not as cheap as you think, and maybe where you should be looking instead to be finding some great stock ideas. Tune in now.
Stock earnings and favorite pastime.
So let me just say, earnings
Liquidity
work
with Wall Street. That's 2.5x
because their compensation goes up.
Wall Street's wrong again. Wherever you look, there are reasons to be concerned about the consumer, right? I mean, we've got consumer confidence levels that are plumbing really historic lows. I mean, this data shows you basically since 2022 how we're at 4-year lows, but it goes bigger than that. If we look at the Michigan Consumer Sentiment Index, what you can see is we are at levels that we basically have only hit in the worst of the Great Recession and the the worst of the post-COVID hangover in 2022 in terms of consumers' concern and everything that's going on. And you look at it, right? Part of the reason is whether or not inflation numbers are actually trending down or better than the headlines think. People are worried that inflation is going to start to climb, right? I mean that we've seen in just the last year, people go from expecting that inflation was going to settle around 3% a year going forward to 3.5 to 4 with tariffs and everything else. And we've got, looming issues with unemployment going on in terms of youth unemployment rising. We just saw, of course, that, the revision in terms of vanishing 1 million jobs that we vanished from the U.S. economy as we got the revisions. There's a lot of reasons to be concerned about the consumer. And that doesn't even get into the idea that the consumer's income statement and balance sheet are starting to get a lot more pressure too. Everybody, you may have seen us talk about this before. This is delinquency rates for consumer credit, right? Each of these is everything from mortgages to auto loans to credit cards and then student loans. And you might notice one of those lines, student loans, goes from basically zero because we had forbearance and nobody had to pay their student loans to now it is rocketing up to north of 10%. In terms of what delinquency rates on student loans are, as credit card loans have basically reached levels not seen since the Great Recession. So Joel, there's a lot of reasons to paint a picture, right, to say that we're really worried about the consumer. Fair?
Yes. And the stock market, the consumer stocks, have become increasingly smaller as a piece of the whole stock market. You can actually see that the consumer staples and consumer discretionary used to be a much wider piece of the stock market, has been shrinking as tech and other areas have grown and expanded in their dominance of the stock market.
Right. So everybody, for context, what this chart shows you is over the last 30 years, what percentage of the S&P 500 market cap is made up of each of the different sectors: tech, energy, financials, and of course, consumer discretionary and consumer staples, right? The two parts that most explain the consumer. Well, if you look back, if you think in the peak of the dot-com boom, consumer was doing great, but tech was the biggest focus of the market. At that point, the consumer, as you might call it, consumer discretionary and consumer staples, was 18% of S&P 500 market cap. If you look then going to the the Great Recession, the bottom of the Great Recession, right? This is March of 2009, when we were just in a miserable place for the consumer. Finance had just gotten wiped out and everything else, but the consumer was still 22% of S&P 500 market cap. And now, if you look back in 2020, in the bottom of COVID, March of COVID, when everybody thought the consumer was ruined, the consumer was still 18% of U.S. market cap. Well, now we're in a situation where the consumer is less than 16% of U.S. market cap. And so S&P 500 market cap. So Joel, you and I were talking when we saw this analysis, which we presented on a prior episode of Altimetry Authority, but we were saying, hey, does this mean the consumer might actually be a buying opportunity? Because it is, consumer discretionary and consumer staples is a very small percentage of U.S. market cap right now. And so we thought it was a really good way to potentially look at that, Joel. And you want to take everybody through what our conclusions are?
So because we calculate the return on assets for every consumer staples company in the United States, U.S. listed, we can aggregate it and say, let's get a feel for it. And yes, in 2021, consumer staple stocks had an incredible year, right? You can see a peak return on assets there, and it's fallen a little bit back to, I'd say, longer term averages over the last 3 or 4 years. The question is, Wall Street believes that these companies are going to have a really bad year and 2026, a bad next year and a half, with the lowest returns we've seen. The problem is the stock market is still implying that it's going to rebound and back to good old levels. So consumer staples, which of course should be stable. I mean, you're talking about groceries and bread and Coca-Cola and things that, whether you're in a recession or not, people still buy it. And so it is incredibly stable. But those small changes suggest suggest potentially big changes in the valuation. But what we're getting at is consumer staples may be a smaller piece of the market, but it doesn't look that cheap. It does look that cheap. It looks like the market's saying you're going to have a bad couple of years, but it's still going to rebound. In fact, you might even argue consumer staples might look a tiny bit expensive, bit when viewed in this light.
Right, because Joel, to your point, we've talked about this idea that, tariffs may not be as much of an impact on the consumer because corporates may eat some of those tariffs, right? I mean, one, the exporters that send stuff to the U.S. might, and two, the companies that actually make the goods and sell them will too. And I think that that's part of what we're seeing here in terms of that expectation for ROA to step down in 25 and 26 is kind of saying, hey, there will be some margin compression here, and the market just kind of looking right past that. Even with that low weighting. And so now let's talk consumer discretionary, Joel.
So just consumer discretionary, would you expect to be a lot more volatile? You see it collapsing in 2008. This is, things that people have a choice of whether to spend. It's like casinos and things like that. And so if you have a choice, like leisure, right? Hotels. So you have a choice of whether to spend, and if it's a recession or a bad economy, or you're locked in your house and you can't spend on it even if you want to, your returns of those companies will fall. But you can see that as of right now, they're around 11%. Wall Street analysts believe it's going to pretty much hold, maybe dip a little bit, and then come right back to 11% over the next couple of years. But the stock market, to get to the valuations of all these companies in aggregate, says that you're going to have to get back to basically peak return levels. So what we're getting at is for both consumer staples and consumer discretionary, even though they become smaller parts of the stock market, that doesn't mean they can't still be a little bit on the expensive side. Or at least, let's say, richly priced, fully priced anyway. I'm not saying we should go out and start shorting consumer discretionary stocks. Right? But I don't think there's anything here screaming this is a bargain opportunity to be buying into some consumer discretionary ETF or something like that.
And everybody, right, you might fairly, if you know anything about how aggregation works, say, well, whoa. If you're going to talk about valuations for the consumer, did I miss two whoas there, Joe? Whoa. Then so you gotta basically remove the two largest companies that have nothing to do with the consumer and consumer staples, which is you got to remove Amazon and Tesla, because obviously Amazon and Tesla, yes, very consumer exposed, but the valuation for Amazon and Tesla, we all understand, is Amazon, it's all about AWS and AI, and for Tesla, it's all about robotics, it's all about AI, it's all about everything else that is pushing those two. Even if we remove Tesla and Amazon from this aggregate, which, as you can see, I'm going to flip back and forth here, doesn't really change historic profitability much for these companies, for the consumer discretionary, but it certainly changes valuation. But Joel, to your point, even adjusting for that, the market is basically saying, yeah, we think consumer discretionary companies will be mid-cycle going forward, which isn't cheap, and is a reason why we're saying, yeah, this is everybody. You might think that we've got this opportunity because the consumer has been beaten up because of all those headline risks we talked about, and it's now a really small part of U.S. market cap, that it's a buying opportunity. It's not. The market is not undervaluing these companies at all. It's reasonably valuing these companies, and it's probably better for you to, instead of bottom fishing on the consumer, focus on riding where the real fundamental momentum is, and that's in the areas around AI that we keep on talking about here, and that we're probably going to talk about next episode if you all tune in. And so with that, everybody, if you enjoyed this, so go, Joe.
This is one where you're not going to be able to find really cheap, high quality stocks that you're getting a bargain. This is where you start looking for companies that maybe have slightly elevated PEs, but are growing like mad, and that the PE still, even at an elevated level, doesn't reflect the fundamental momentum of the company, I think that's where you're going to find some really great stock ideas in the coming years, particularly in this space, given how it's sort of richly priced already.
And so everybody, tune in next episode where we might be talking about areas we are seeing green shoots of investment, that there's an opportunity. And if you have a big picture topic you want to talk about, or maybe you just have a company you want us to look at it, drop it into the comments and we will make sure to cover it in a future episode. And with that, hit the like and subscribe button and come back next time. This is Altimetry Authority. Thanks, everybody.